I get it. Well, we'll jump it off here, and so I'll just kind of be moderating this session a little bit, and it's going to be Gibran and Brian to kind of steal the show. I'll try to stay out of your way, but Gibran, why don't you introduce yourself and tell us a little bit about what you've been up to? You've got some really exciting project you've been doing there.
Yeah, thanks, Doug. So yeah, my name's Gibran Rajesh Charles. I'll put all my details in the chat so everyone can find me on LinkedIn and contact me. So I'm the CEO and founder of a hedge fund called Urban Edge Capital. And what's quite unique about us is we're the only hedge fund in Europe anyway that is specifically focused on diversity inclusion. So within this sort of ESG family, we firmly fit in the social. So we're quite proud of the fact that we're one of the very few, if only, hedge funds to master and calculate a strategy, an investment strategy around social and being able to create diversity and inclusion as an asset class. So my background is born in London. My first, I've sort of worked in a city since 1988, so I'm showing my age a little bit. And more recently, so I've worked in sort of sales trading, more trading and sales and in wealth management. 2016, I was invited by the European Parliament to work in their Economic and Monetary Affairs Commission, which basically meant my job really was to work with MEPs and other European banks and global banks about how we set the next 10 years really, and looking at things from cryptocurrencies to fintech to the rise of Bitcoin and also rules and regulations about, banking sizes, and also Brexit. So Brexit was the big argument. What do we do about Brexit? Where do we put these banks? What's the future of currency, et cetera, et cetera. And within that role, one of my remits I was given to task with was looking at global wealth and the distribution of wealth, more the point. And my sort of area of governance was the UK and London. And then, obviously doing the research, I found that obviously, knowing coming from a Caribbean background and the sort of Black community in London, there was a disproportionate amount of wealth going from different demographics. So my discovery was to look at why that was happening. Why was there such a preponderance of financial exclusion in the UK communities? But what this does, it sort of sent me down a rabbit hole. And I only had, at the time, I remember I only had about sort of 6 months left in my contract at the European Parliament. So I was like, okay, this is interesting. And I was deciding what I should do about my next career, really. And I found myself going down the route of financial exclusion, which dates back 70 years in the UK. So very much from a UK perspective. And the fact that, obviously with more higher paying jobs, you have less diversity. When you've got lower paying jobs, you've got more diversity. So that was interesting to me as well. I then discovered the idea that diversity inclusion was, for 20, 30 years, always used as this kind of, in my eyes, this 1 hour boardroom exercise where you go and talk about, hiring and diversity and how it's great and great for the business and whatever. And then after lunch, everybody forget about it, and for me, that was quite fascinating. But then I came up with this idea of what if we took diversity inclusion as a non-financial entity, and then we made it an asset class? What if we put it to the other side and made it something that companies and CEOs and investors could really get hold of, make it tangible, and make it, an element or an instrument you could actually trade and make money off? And I don't mean it in a very crude way. I do mean it in the way that, unfortunately, the only way that companies will understand how powerful something is when you attach it to finance and their purse strings. Okay, so obviously a very good cause. Diversity inclusion, as we know, has a very moralistic side. But what I want to do was I want to take it from the moral side. And yes, it's a very good thing to do to have diversity inclusion. But I wanted to make it mean something and say, well, cool, look, actually, we can actually make money. This is a really good thing. And actually, if we focus on it and actually know how to empower it really within our businesses and also our communities, we can actually be a much better profitable enterprise. And as Brian said, companies, investors want to invest in good companies, but I think we've turned a corner now where the sort of crude greed is good days of the 80s and 90s are over. I think companies and investors know the value of investing in good companies. So I had this idea that I was going to start a hedge fund. My previous life, I tried to do a fintech company, which sort of didn't really work out because the cost of carry was too much. I then looked at the idea of doing this hedge fund and working out if I could actually do this. So the first place I went to was I had a contact at Goldman Sachs. So it's a true story. I actually phoned up Mark and said, Mark, I've got a great idea. Let me come and see you. but bring your team. Like, I want to, bring the guys and girls involved. So he organized the boardroom. And I remember getting there really late and I was sweating and I'd BO, my shirt was smelling. And I was like, oh, this is not a good way to start this meeting at Goldman Sachs. And I said, literally, guys, that, I've got an idea about creating, investment strategy around diversity inclusion. And I think it's going to blow up. I think it's going to work really well. The research is epic. Boston Consulting Group and McKinsey have all proven this is a right strategy. But I want to actually execute this. I want to try and see if I can actually get this to the ground. And there was this sort of deafening pause. And I remember saying to them, I can talk about race, but you can't. And then it was just, and I thought, I shouldn't have said that. And there was this kind of deafening silence in the room and this kind of sort of awkward stares. And then, one of the senior managers said, do you know what? I really like what we've got. That's a great idea. And I was like, oh, wow. Okay. So what I thought was going to be a 15-minute meeting turned into 2 hours of discussion. And then they said, yeah, go away and come back when you've got more of a solid business and an idea. So I a year and a bit later, we've got there's 4 of us and we're emerging managers. So we're quite in our infancy, but the feedback and the endorsements we've got so far are quite epic. We've got Goldman Sachs, JP Morgan and Bank of America, Merrill Lynch, who are acting as our prime brokers. And their job really is to help us get, our seed investor and our anchor investor through strategic partnerships. But the idea of this idea of diversity inclusion, what was tricky is because it's in social, right? So social is one of the areas that hasn't really been nailed down the way environment and carbon has, or the way governance has with the behavior of companies. Social was still this kind of, I think in a paper I read, it was still sort of ugly duckling of the three in terms of how do we make it grow and what's happening. But what you've seen and what we've seen certainly in the last year and a bit or last 2 years is not only what I call corporate absolution, which again, the George Floyd death in last year really kicked off a massive upsurge in companies, again, doing this corporate absolution, which is basically companies from Taco Bell to Disney apologizing for really poor HR policies or bad negligence of minorities and women in the workplace. And so we kicked this off, and then obviously we just sort of became really popular because what we were saying all along was diversity inclusion makes you money. It really does. It's if you understand ESG, it's part of the triple down. It really does work. And we really wanted to back this up with evidence. So we contacted Boston Consulting Group and McKinsey, and they sent me documents and paperwork of evidence, which I'm happy to share, guys. So please do contact me. I'll send you the stuff that we found, and we actually wrote a paper about this. But we're looking at a profitability of 34%, which is staggering if you think it. 34% of companies that included diversity inclusion into their companies are showing a rise of up to 34% in their bottom line. So it does work. I think the issue really is how companies include that, and what part of what I'm doing really is educating companies into this and sort of helping them understand how they can achieve that diversity inclusion from a financial point of view, not from a consultative point of view, but more from this is the sort of steps you need to look at. And also what I'm really conscious of is the idea of embarrassing CEOs and investors, because I've had several conversations where they understand that they've been a bit negligent towards the idea of getting women into exco levels and also hiring minorities into positions such as portfolio managers. In the UK, we've got a devastatingly low ratio. I think it's like 0.5% of Black employees actually running money in any bank or any form. Traders, yes, but actually portfolio managers running, billion-dollar funds is just not there. And that was a question as to why that was. And that led me to then start a charity called the Urban Generation Trust, which is about getting young adults and kids off of YouTube and football and being an Instagram celebrity into things like banking, finance, being a judge or a QC, or being a medical professional. I think for minorities, the issue was access, right? As education access. So we found those issues was important to look at. And I think what makes the Urban Energy Capital really quite a true ESG company, and Doug, I hope you asked the question about greenwashing, because I'll really kick off then, is the fact that we actually do have, we actually touch the ground. We actually can see the effect of what we're doing happening in companies. And, we can actually see the effect of kids getting better. we see the effects of companies getting more profitable because we're actually part of that solution.
Well, I'm going to ask you the greenwashing question in a second, but first, but before I let you go off on that one, can you tell me a little bit more? I'm really curious to know how you measure. What are your metrics for these issues, and is it self-reported? Is there any independent verification? How do
Yeah.
you hold people's feet to the fire and know that what they're telling you is accurate? And which metrics are you measuring? How are you measuring them? Tell me the data process that you're using to actually score these companies, because that's
Yeah. Okay, brilliant. Okay, so firstly, let me just share my screen and show you one slide from my presentation, so I can just find it. How do I do this now? I did have this set up somewhere. Let me see if I can.
And maybe this is a greenwash. Maybe this ties into the greenwashing question as well. I'm not sure.
Wait a minute. Can you see my? Let's do this.
I see your
Okay,
screen.
let me. Right. Okay, guys. So okay. So what I'm showing you here is you know, 2019-2020 graph of Refinitiv or Thomson Reuters. And what we're seeing here, we're seeing that the blue line, the dark blue line, is the diverse. They have their own diversity and inclusion index, okay, which is massively outperforming the global total returns index, which they also measure. So what we're seeing, and what we've seen for the last 25 years, is that, you know, sustainability funds are continuing to outperform over a 10-year period, okay, and it's continuing to grow. And with the sort of continuance of companies and pension funds putting more money into ESG, we're seeing that these funds are beginning to reap benefits. And now we're seeing a sort of shift. So that was just a little example of the sort of levels of returns that we're seeing, and the ability for companies to really have a focus on a clear alpha, right? So the ability to separate the beta and focus on what is driving that alpha. And for us, it's the DNI. Let's stop that screen there. So a good question about that is what I'm measuring. So what we had to do was create this investment strategy, okay? And it was tricky. I mean, we've got Peter Shell is but without out one of the best European portfolio managers in Europe, and we snagged him because he has a very good heart, and also he believes in the idea of what we're doing. So we managed to pinch him. And what me and Peter did was look at what data was available, and the data that we have decided to go with is a fantastic company called S Factor, who we're working closely with, and we've got some exciting news about that later on in the year. But also Refinitiv have got some, well, Refinitiv were the ones that were actually giving some really good data and also giving us controversy scores as well as ESG scores. But we all know that, you know, the ESG data world is so messy, and, you know, you've got one group of people saying it's, you know, BlackRock is this score, and then another guy is saying that it's that score. So we had to create our own screens, and myself and Peter and Ling, who's our quant, basically designed our own screens to filter out from millions of data points what actually was true to the company and the ESG scoring. So we get, I think it's 2,600 global relevant companies that we look at, and then we filter it down to 50 longs and 30 shorts. And how we measure that is not only by looking at the ESG scoring, but also using our screen data and also back testing. We've got another company that has got sort of 10 to 20 years back testing data on these companies. So we're able to really dig down into, you know, the quantamental sort of issue of finding out if these companies are really genuine. But also what Peter's been doing, and he's been really commendable in that, is he knocks on doors. Okay, like we have to see what's behind the door, and I'm a big proponent of that. I'm a big fan of that. You know, by nature, we're a fundamental house, so we use quants very much, but we're not a quant-driven strategy. And what that allows us to do is to really find out the methods and the motives and the intent behind some of our CEOs that we're dealing with and we're talking to. I'll give you a good example. I mentioned yesterday, we're one of our target companies that we're looking at, we haven't really included yet, is JD Sports. JD Sports is phenomenal. It's done 7 billion. It's growing at a staggering 400%. And when I looked at them and when I sort of started to research them, they reminded me of the old Nike of back in the sort of 70s and 80s, when Nike realized that, wait a minute, we're selling, close to 99.9% of our Nike trainers to black males within, the New York region and the basketball community. But then that wasn't reflected within their marketing department or their sales department. So the question was, well, is this cultural appropriation, or what was this issue? But they quickly realized that they had to address this. Now, what the similarity is that JD Sports have very cleverly captured the 8 to 18-year-old minority urban, and I say urban in an economic, not cultural sense. So urban, you've got multicultural living in the States and around the world. So we're looking at low-income families who the culture. There's a great. I mean, I've got this in a paper I sent you, but conspicuous consumption is a phrase termed by a Russian professor in the States, which dates back to the idea that minority communities wore what they earned because they weren't included in the financial system. Okay, so if the reason why we have this sort of bling culture and the idea of rappers wearing all this jewelry, whatever, is because it dates back systematically from 78 years ago, where a low-income household. I mean, you had redlining in the States. Over here, we had financial exclusion. My grandfather served in the RAF. He came back to the UK, but still wasn't allowed to have a bank account. So he wore, the money he earned when he worked in, McVitie's biscuit factory was in a brown envelope, and that was put under the mattress. So the idea of conspicuous consumption was the idea that you wear what you earn to show your community that you're doing well and you're prospering. This then translates to my point, which is JD Sports seem to have understood that, and now they've captured these kids where it's tribalism. The better trainers I have, the more status I have. Okay, so they realize this. So their marketing on Snapchat, Instagram, Facebook is below the line. So it's very much targeted at these kids. They're giving out trainers, t-shirts, footballs, free apparel. They're sponsoring Anthony Joshua, who's a well-known heavyweight boxer in the UK. So these kids are attaching their identities with this brand. Okay, I mean, it's powerful. I mean, they're a retailer, but they sell Nike, but the kids love JD Sports. So I've been watching now for about 2 years, and my issue, back to my point, is how we measure and how we get inside these companies is to say to JD Sports and Peter Cowgill, look, Peter, what are you doing internally? How are you reflecting this market share capture you have of all these kids within the company? We see you've got a charity, but that still doesn't say anything to us. I mean, what does your staff look like? What does your sales department look like? How are you communicating to these kids that, I mean, especially in London, we had a massive knife crime issue, which suddenly went away when COVID happened. But we had a massive knife crime issue. Kids were getting killed on the streets every day over gang-related issues, drugs, and other such crimes. But yet trainers and apparel was still number one. And my issue was, are these companies addressing it? So, looking at communities and holding them to account for the communities that they serve really is how we do that. And as a hedge fund, we can say, look, we own 25% of your holdings. What are you doing? Because if you don't adhere to some of the recommendations, we can be a little bit unfavorable. So
let me ask you a question then on that. So what is it about the diversity and inclusion that makes these companies more profitable? I mean, what underlying makes that, besides being a cosmetic change, right?
Right. Very good.
Why should someone adopt these practices, and what's the driving force behind it?
So I mean, I don't want to be glib about this or be quite basic about it, but it's quite true. It's kind of like, if you do you like spicy food, Doug? Do you like any food with ingredient? Yeah. So if I just gave you a warm boil of water with a lemon in it and said that's a curry, would you believe me?
No,
right? Okay, so we know that right. Curry is made of, and it's the same thing. It's like a thundercloud, lightning is negative and plus particles come together, causing friction, and you've got this loud bang, and you've got this lightning strike. It's the same with companies. What we have to understand is that people are very unique, and it's the background and cultures that create this dynamic force. And what we worked out and what we calculated was innovation revenue. Innovation revenue is the key factor that drives innovation with the companies, that drives this profitability. And innovation revenue is basically goods and services derived from the past 3 years. Okay, from sales, from goods and services in the last 3 years is what drives innovation revenue. So that's why we're seeing massive growth in tech stocks, and startups are aggressively growing because they've worked out that having a different background of cultures, and it's the arguing, it's a difference of opinion, it's the fact that, well, you know, where I'm from, we do it this way, and other countries, well, and it's that debate that creates this kind of unique nuclei and this kind of unique atom which spawns these ideas. And that's what's happened. If you have a completely homogeneous office base, which we've had in business for so many years, it doesn't drive any cultural in any cultural sort of dynamics. And I think culture is very, very important. And I think that ingredients adds to it. And, you know, as I mentioned, I've had conversations from CEOs before who've whispered to me privately, and I don't mind saying this. And they said to me, well, Gibbon, look, if I have more, you know, black and women in my company, do I make more money? And I said, well, it's not as easy as that. You can't, you know, you can't just add people in and say, yeah, there you go. You know, it's the diversity and inclusion. The inclusion is the glue to this whole mix, right? It's how do we, over time, and we're seeing changes as quickly as 3 months, right? Where, you know, if you have the right processes and steps in place to empower staff, to give more responsibilities to staff, you know, we're seeing, you know, I've got a report here that says, you know, companies that have women in the exco level, not at the board level, but at the, you know, the executive level who are actually executing the ideas, we're seeing a 2.3% share price improvement, right? Which is drastic. I think what's happened is that it's the beginning of the curve. I mean, people are coming around to it, and it's late to the table for people to realize this, because we've always framed it from a moralistic point of view. We've always framed diversity inclusion as a good to do. It's a right thing to do. It's equality. It's the sort of social feel good. And now what I'm saying is, yes, that's very right, but look at it from a financial point of view. It actually makes money. Companies that are catching on to this, such as Coca-Cola and Netflix, are releasing great D&I statements, are making money out of this because they realize that I'm empowering a staff member who is actually really giving some great ideas. Just one last point. I remember when I was a trader for the Life Exchange in London many moons ago, and I was in my sort of early 20s, and it was a very kind of very white, very male, very sexist, very racist. It is a pit trader basically, like the CBOT or the Merc. It's very, very intensive with lots of hand signals going on, and it was only 1 or 2 black people on the floor, you know, mixed with Chinese guys on the floor, Indian guys. And I was like, well, I'm not sure if I'm going to take this job because it's pretty, you know, gutter, locker room trash, and sort of talking. And I remember my boss, Lizzie Moore, said to me, Gibbs, look, you know, we don't care what color you are. If you make money, you make money. And that was kind of the point. I mean, that's the crudeness of how the financial city in London works, to a sort of point where the chit chat was very much kind of a bit racist at the time. It's changed now, thank God. But back in sort of early late 80s and 90s, it was pretty tough. But now that's changed. And I think we're seeing that, you know, the inclusion, especially women, are more empowered. I mean, we're seeing, I think, what's his name, Mr. Wonderful from Shark Tank says that, you know, 9 out of 10 companies run by women are making the most money. So I think it's the fact that we're late, you know, companies are late to the game in understanding diversity inclusion, and they are now realizing how profitable this actually can be.
Well, I haven't forgotten the greenwashing question, but let me bring Brian in here a little bit, give him a little floor space.
Yeah, Brian,
and let you, and Brian, maybe do you feel like you want to talk a little bit about, you did a great introduction in the earlier session about what you're doing at Natixis with your sustainable futures funds. Could you talk a little bit about how you're seeing these metrics drive your profitability? Because your fund performance has been exceptional. So how have these factors played into your funds, and how do you address these issues on governance and equity inclusion with Natixis?
Yeah, and just to touch on the diversity inclusion, what we were just saying there, I think I made a note here about like the impact that a diverse board or you know women in leadership has on younger employees. I think is what really makes the companies great, because then you have a younger employee that's like, oh cool, like I'm a woman, or you know somebody like that they have a CEO, and then you're a young girl, you're like, I can be that, you know, where I think 20 years ago like that just wasn't the case, and probably makes someone work less hard, and you know a number of different things. So really cool stuff. Our metrics have really changed. They're a little bit different, I would say, because because of DOL rulings and because of regulation in the US on the 401k side, we need to put financials first to be in line with what the government wants us to be in line with. So we put, is this a profitable company? Is it a well-run company? All those things have to come first. Financials have to come first. And then we put our ESG screens on top of that. And that's just how it works in the 401k space, kind of for better, for worse. For worse is that it's not probably as green as some folks would like. It's not going to be 100% green because you do have to put financials first. But at the same time, we've been very strong with our performance. And I think it proves that this level of due diligence and adding that layer of ESG on top of the strong financials is a process that can really show you how to outperform in the long term. Because on the environmental side of things, I just can't envision a world where it doesn't continue to change and trend in this direction, that if you're not doing the right things environmentally, if your factories are not doing the right thing, you're doing things that are harming the environment, that you're not going to get found out of, and you're not going to have that affect your stock and your company. And then, as we just heard very eloquently, the social stuff it's almost, since, I really think almost a year ago now, it's gone into a hyper speed mode, which is good. The issues that happened almost a year ago have really accelerated everything in my eyes. And that's great. I think if forget the diversity and inclusion stuff right now, but if you're not treating your employees well in this day and age, they're not going to work for you anymore. It's just, there's too many options out there in the world to be like, I can go do this and work from home and be at my computer and have a job. Where, in the 70s it was like, all right, I got to put my suit on, get my briefcase and truck into the city to find a job. Like, that's not the case anymore. And you just took whatever your mean, annoying boss just beat you up all day and you accepted it because it was a job. Now you could find another job in a week on LinkedIn or whatever. And then the governance stuff is, I think, probably been there the longest, but may also be the most overlooked in its importance to how well a company is really run. Because I touched on this when I was presenting earlier, like if you just look at I think looking at the makeup of a board gives you, and not looking at its stock price, not looking at financials, I think it gives you a really good idea of what the stock price is going to be and what the financials are going to look like. Because if that board's a mess of people who have no experience in that industry and it's just friends of the CEO, it's not going to go well for that company, because no one's answering the hard questions, no one's pushing back on the CEO, and no one has any experience. They're just there to collect a check, and probably a pretty nice check at some of the big corporations. But so, our metrics are a little bit different in that, like I said, the financials have to come first, and then our level of ESG evaluation and due diligence comes on top of that. And there's a lot of companies that probably true ESG folks would not like to talk about as green companies, but does Walmart have its issues? Yes. A company like Walmart 100% has its issues, but they're a massive player in the US market. And if they want to take a gigaton of carbon out of the environment by 2025, that's a good thing. So you kind of have to find a way to figure out, these companies may be doing something wrong over on the left side, but do they have the power on the right side to really make significant change? And then that's where the greenwashing debate comes in, is what's really happening there? Because as I touched on in my presentation before, nothing is more infuriating for me that, we'll meet a company and we'll find out let's say they have a $50 million 401k plan. And they're 100% backing sustainability. We love the environment. We love people. We love a well-run company. And then you're like, well, great. We have a great option for your 401k. It's a really easy switch. You get in touch with someone like Doug. Will you make it happen? And they're like, well, no, we're not going to do that. We want the cheaper XYZ option. You're like, what? I think that's the really frustrating world that we all live in. And it's like, looking at somebody's website does not mean that they're actually on board of the sustainability train. Because as I mentioned in my performance, we work with a bunch of smaller affiliates, and they get institutional mandates. Mm-hmm. So the pension endowment of these massive places, if you don't do ESG due diligence, you're not even getting a seat at the table anymore. It's just not going to be something. They're not going to allow you to come and be like, yep, we just run a traditional portfolio and with 60% equity, 40% fixed, and we'll call it a day. It's like, no, that those ways are gone on like the people who actually are running the smart money. That's just not the way of the world anymore.
Mm-hmm.
Yeah.
But so, go ahead.
Yeah, so I've got a quick question there, Brian. I mean, what do you, and also for you, Doug, as well. I mean, we've looked at sort of sheer compliant funding as well, and also the idea of what's your views on like negative screening. So we do negative screens as well. I mean, one of our first model portfolios that we built had Raytheon in it as well, and I was like, oh, that's not really good. So, but I mean, again, it's kind of this balance between, shareholders, obviously stakeholders want money, and I think they're coming around the idea that the moralistic side is good, but also they need to make a return. And I was just wondering what your views are on sort of negative screening, where it's alcohol, pornography, weapons, tobacco, that thing. I mean, do you negative screen, or is it completely sort of the returns first and then we'll look at?
On the 401k side, we can't do negative screening, so not on that side. But on our other products that are ESG, we definitely do that because, again, people want that customization too. Like these large institutions, if they come to you and say, we don't want guns, you're going to make sure there's no guns in the portfolio because that's a lot of money that you'd be passing up if there was guns in it. So we definitely do that, just not on like kind of the side of the business that I'm on. But I think the only downside to negative screening is like the bad rap it got in like the 80s when people were doing it and performance didn't work out. But I think people are seeing now that this is a major, and I said in my presentation, it's like ESG and sustainable investing is like a feel-good story, but it's a performance driver. That is the true, in like, as you just mentioned, everybody loves this until they start losing money. So you have to be good at what you're doing, right? Like everybody loves this story until they're like, oh, damn, I was down 12% last year. Everybody else was up 10, So it has to work on the performance side.
Yeah, absolutely.
And I just, so disclosure, so we do negative screening with my firm. And particularly we were doing it with our 403B and 401k plans. So just a little background, I'm technically also a participant in the panel discussion besides just moderating, but I think both of you have far more interesting stories, but I actually built the first ESG 403B retirement plan with a default investment into sustainable funds. And there were no off-the-shelf products like what Natixis is offering in terms of a target date ESG portfolio fund. So I actually built a series of model portfolios, all ESG, put a glide path on them, and they weren't funds; they were just portfolios, and put them in as our default QDIA for we were the first ones kind of out of the gate in the 403B space to do that. But then we kind of got, and our performance was great; they were doing really well. But the regulatory compliance side was just very, very difficult. And then I actually ran into Brian at Sustainatopia, and he was telling me all about the Natixis funds. That I actually switched over to Natixis because they actually outperformed what I was doing. And they were doing it in a way that was more regular. It just made the regulatory compliance thing. They've got $1 trillion in AUM, and it's just me and my little shop here in Santa Fe. So it made total sense to go that route. But we have done negative screening and still had great performance. So we didn't invest in things that involved, say, child labor, slave labor, weapons of mass destruction, guns. We had anything that involved. We really tried to get as fossil-free fuel as we could, although we still had some energy investments in there as well. But long-winded answer to your question, Gibran. But yeah, so we do have and continue to do on our wealth side some negative screening. But I think what Brian is doing in Texas is a little more robust and much more innovative and much more easy to navigate in the world of our ever-shifting U.S. political system. So.
Kevin, I wanted to ask you a question too. You were talking about Nike, and I remember those days I'm 38 of like Michael Jordan in the U.S. and like everyone had to have a pair of Nikes, even if you like didn't play basketball, you just had to have a pair of, And I would say like it's really interesting how companies, like I look at Patagonia in the U.S. and I don't know how popular they are in the UK or Europe, but like that's like now become a thing of like if you wear Patagonia, like you're on the team of like a well-run company that invests in climate change and wants to do things at the government level and stuff like that. Do you see that as a way to kind of trying to relate this back to the diversity and inclusion thing of like, is that going to be brands doing that as a key driver? Is that going to be a key driver to their business? Do you think, is like getting these young folks involved through their products, and then that kind of changes the whole corporate culture?
Yeah, I mean, I mean, obviously the demographics of the UK, well, and we're in London anyways, is, you know, very densely populated. So as mentioned before, urban, we say urban as in a community of inner cities, and within that inner cities, there are kids from sort of lower poor backgrounds. But I guess we're because the makeup of communities are so mixed. So you've got, you know, people from, you know, Black, Irish backgrounds, and all growing up together. What you're seeing is it's not so much a sort of a culture clash of diversity inclusion. It's more, it is the brands that we wear, because the brands that we wear represent us as a group, which is good. So it's a case of that sort of saying. It's recently it's coming out. You're seeing companies making a statement of diversity inclusion, and doing a lot more reporting on it, and the data. I think the data has always been an issue of companies being transparent about what they're doing. But again, I honestly do believe the culture between the UK and the States are so different. I mean, UK companies still have this kind of stiff upper lip and don't want to admit that they're actually making a mistake or they need to change. And if they do that, they'll do it quietly. But I think the popular brands that are more popular with the kids, they will do that. They've always been one, well, you know, JD Sports have been one for sure in terms of promoting people from different backgrounds in terms of TV. Nike has also been the same. Apple as well, you're seeing it as well. But there hasn't been a segregation of communities so much. So there hasn't been a need of saying, well, we need to be together. It's been, okay, well, this brand understands a third challenge, which might be, you know, education or poverty or you know, knife crime or some sort of third enemy, but unification of those cultures. I think that the issue, I think it would be very different if corporate brands came out and said that they were in support of, I mean, you know, diversity inclusion, rather than retail brands. Retail brands, I mean, again, what you have is, and this is quite a clever sort of side note, is within this corporate absolution debate and dynamic, what you saw was a clear distinction of two companies were saying, well, great, let's go and wave the flag of D&I because it will show the world that we were really good. But it was just a PR exercise, and it was really good for getting branding out there and making these people think they were doing well. But then what you had real companies going, actually, you know, we've drilled down, we looked at the numbers and realized that actually we do need to actually incorporate a plan of getting more women on board and more ethnicities into senior positions. And they've shown the best results, because obviously the PR exercise only lasts for so long and then you get sussed out. So I think, again, back to your point, I think that's working well with some of the younger kids and some of the retail brands that are helping that out. And then what we're doing as well is that we're trying to merge the two worlds, really, saying, look, you know, not only can you be this great athlete or social media star or entertainer or personality, or influence, what you want to be, but also you can actually be a great business person, entrepreneur, and so forth. What I will say is that brands like Goldman Sachs and some of the bigger brands have realized that, and that's kind of, you know, at first I was a bit sort of, when I didn't know them as well as I did, and they were just another counterparty to me when I was working in the city, is that they really come around now, and they've launched GS Launch, which is really helping younger minority kids get off the ground with their own startups. So I think, Brian, what you're seeing is that some of the clever brands and some of the smart money is going to investing in kids and women from minorities and just, you know, backgrounds into starting their own business, getting them on the road to success in terms of entrepreneurship, which we're seeing more of, where, again, brands are more celebrating the idea of unity and coming together to fight a definite cause. On the corporate side, as you're seeing, much more like SoftBank and Goldman, for example, launching funds to help, you know, non-financial entrepreneurs start their business.
Yeah, and I wrote down another thing when you were speaking earlier, like, and just being that in 6 is 10 years, like, I totally get what you're saying on, like, you used to have 10 years ago or 9 years ago, you'd have the meeting on diversity and inclusion, and you'd be like, all right, sweet, check that box, don't have to do that one. Do it for another 6 months.
Lunch.
Yeah. Now I feel like, I mean, most bigger companies have roles and teams dedicated to making this like a central thing that is happening on a day-to-day basis. And it's really amazing to have seen that type of change as well.
Yeah, I mean, and what you'll see, I mean, obviously we're all LinkedIn participants there. I mean, I'm seeing just my newsfeed anyway, this growth in D&I consultants. And I think they're getting more empowered. But I think, I have these talks as well. And I get, my point is, my job is to make my stakeholders money. That's my number one goal. That's all I do. I mean, I've got a great heart. I love pets and animals and small puppies. But at the end of the day, if I don't make money, I don't have a job, and my existence is just that. So I have to really boil down to the idea that what I do is about making a return for my stakeholders, my investors. At the same time, when I'm delivering sort of talks and speeches to some of the D&I consultants, really, it's kind of getting their heads into the idea that D&I yes, it's very good, but it has to, in order to make any change, and I said before, CEOs and chief execs are owed to their stakeholders and their staff, because they've got to pay their staff. If they're not making any money, they don't have a business. If they don't have any staff in their company, they don't have any business, right? Mm-hmm. So some of the D&I communities I'm speaking to is I'm having to show them that the financial aspect of what you're about is really important, because they're still very much on the side of, it's great to do D&I, and it's really important because of the racial issue and the unconscious bias, but also empower the side of the financial well-being. It actually makes so much money for you to also include that in your statement or include that in your presentation, because I think that will help the CEOs react faster. Apart from the idea that it's great for HR, it's great for empowerment, it's great for, gender diversity and all the other amazing benefits that D&I do. But we have to include the accounting side. We have to include the financial side, because I think that's what, there's nothing faster than telling a CEO we can save you millions of pounds or make you £1 million for him to pay attention, right? So I think that's what I do as well. So that's where I'm trying to sort of bring the worlds together.
Yeah.
So then I guess the question for both of you is then, how are these issues not financial issues at the end of the day? I mean, Brian, you're saying particularly with what you deal with, the ERISA law and DOL rulings and all that good stuff, and your commitment that you have to put the financial factors first. But how is this not all financially relevant factors from top down? Why isn't everybody doing this? Essentially, is kind of a interesting question.
Yeah, that was our response to the DOL from the Trump administration. It's like, well, all of this is financial. Everything that you're talking about should be considered financial, because it all has an end impact on the stock price eventually. I think that was one of our big gripes with all of the news that came out on that, is that just because it's ESG or just because it's impact or SRI or whatever it may be, doesn't mean that it's going to lose you money. It's just not the case anymore. So yeah, that's it should all be included, if it's not done, as we've sort of discussed a couple of times, like in a greenwashing way. If you're.
So what does that greenwashing look like? Can you give us some? I mean, what are you seeing happening among the industry that you would classify as greenwashing, and how do you avoid it?
You were ready for it.
I mean, if you go to my LinkedIn page, I wrote a very scathing article about. I mean, I was that much from swearing and chat, because Doug, I've seen it firsthand. Where I mean, Brian, you gave a very sophisticated view of greenwashing, where these companies are, they have funds of billions of pounds, but they're choosing a cheaper option. What I'm seeing is kind of these low-level, mid-range shops who realize that actually all this money is flowing. They're seeing the inflow of money into ESG, especially, they targeted the green companies first, but now they're hitting the social aspects, and then literally seeing that, some of these companies and pension funds are actually giving, millions of pounds into ESG causes and social causes. And then these greenwashers are mimicking, because they are smart, these guys and girls, they're mimicking the behavior and the patterns and the marketing flow. And so, we're really green, and we're all about the ESG policy is, it's going on sort of 40 pages, a bit too long, but they are selling and they are conning these investors out of millions of pounds because they're saying that. But then, in my article, I do say, well, one of the ways to avoid this is go knock on their door, go and see if the rubber meets the road. What are they doing? Where is that money going? And often you'll see the money go straight from the company account to the car park, or to the dealership and then the car park, right? So we're not seeing any impact. And I think impact is a key word. I mean, part of what we're doing has to have an eventual outcome and impact, whether it be green, sustainability, but it's a better word. It's the idea of the end of this conversation, there is an end result that is tangible, and I can see that I started here and I've ended here, and that's the result. Greenwashers are, and I realize that because it just shows the ignorance and stupidity of these guys and girls. They haven't really worked out. They're very selfish. They are the bottom of the barrel pond scum in my eyes. And I despise them, and I'll say it publicly. I mean, I really despise them because they are, in my eyes, they are just a modern day con. They're con artists, really, and they've worked out the way to prey on good people who've got really good morals and really good values and are trying to do better, and they've just latched on like a cockroach. So, but again, there are ways to do this, and again, part of what I'm trying to do here, boys and girls, is not just spout out great D&I stuff. Is I want to, if I can part some knowledge or share some data that I've got with you, please, I'm happy to do that, because I think education is really important about how we avoid this, how we get better. And I think just the knowledge sharing between our communities is really important. So that's quite key.
Yeah, Doug, I would just answer your question with, I read an article the other day kind of about this, about if you have these new teams that are being formed by major corporations, like, that's not the answer. The answer is having those teams and then seeing changes and results from those, having these teams. Like, you can't just say, oh, we got a diversity team, we're good.
Yeah.
There has to be some actionable things that take place and some changes. And they don't have to be like, doesn't mean that it's bad or anything. It's just there needs to be some results that show these are the changes that we've made since we've hired this diversity team. And then I saw another one, and I forget the name of the company. It was like they promoted a bunch of like minorities and females, and they changed their job title, but their manager didn't change and their pay didn't change.
Right.
But it was enough to just be like, yeah, we're promoting women.
Yeah.
And it's like, but you didn't. You just said they're like, now they're like vice president, whatever, some stupid title. And that's like another new thing that's happening as well. Those are like really smaller examples, but that stuff's happening.
I know, Brian, that's what I'm saying. I mean, that's a good point, because I'm seeing it on my sort of LinkedIn timeline. All these people are popping out of the woodwork, and they're now ESG or directors, obviously. But what we're going to watch as well is that there's internal nepotism of well, we'll get Christina to do it, really. So Christina has moved from like probably HR director or not an HR director. She could be sort of admin director. Now she's ESG director. But then her background or experience doesn't reflect that. She's still just pushing paper, but has no real impact or has any initiatives to drive impact within the company. And I think, measurement, I think Andrew said it yesterday, you can't change what you can't measure. I think that's a good quote. You've got to be able to measure it and realize and scope it, and then you can see the impact of it. And I think that's what we're saying is this kind of track one or PR exercise where we'll just say that you're an ESG to kind of fit in with the status quo, but actually you're not really when you dig down. Sort of iceberg theory.
So what are some of those metrics, and how do you quantify this stuff if you're investing in thousands of companies across the globe like Texas is doing? And I'm not sure, so Gibran, how many different companies are in your holdings. How do you quantify this stuff? Obviously, you can't go and knock on every single door. Maybe you can.
Well, that's a good point, Doug. I mean, I think for us, we have to. That's why we've only got maybe 30, 40. I think it's about 34, 50 in our long position on our book, because we want to be able to go and knock on these doors and visit these companies. Mm-hmm. And I mentioned Peter's very, very excellent at doing that. He's really a sort of a thorough guy who goes and knocks on doors and speaks to these individuals. But what we've had to do is rely on a lot of data science. We've got a great relationship with a company that we're sort of hoping to partner with soon that allows us 75 data points going back from age, culture, background. We're able to measure the individual staff and how that impacts on the company using those metrics, and then actually by the role that person's doing and measuring that task involved in terms of has that task met the objective of the department role, has that department then met the directive of what the company needs to achieve, and measure it. We have to measure this really. And then how does that affect on a cost profit basis to the bottom line? And again, I think what we do is, and what companies do is, each company, really each person is a cost base, right? Are you getting bang for your buck in terms of what that department's going to be doing? Is it measuring up? Is the initiative helping? But also being aware and receiving data and feedback from the outside. I think you can't work in a complete vacuum with this as well. You have to be able to speak to partners and measure, and also your customers as well, and measure, what am I doing? What are we doing to solve this problem? Is it solving it? Are we reviewing it in time? So for us, it's a lot of measurement, a lot of data which we've used to enable us to identify what points are important, and then we managed to sort of create screens around that to be able to measure it. But I think the conversation, I mean, there are 6 points. I think there's 5 points, I think, within one of the papers I had, for example, that shows you can create value from ESG, really, which is about empowering your staff member, making sure that they feel welcomed. Are you doing the sort of responsibility of promoting your women and minorities in the company so that they feel empowered? Other ways of integration. So are there programs, are there integration programs, and first day calls where they can feel that they're welcome, and then they're welcome into the team. So, and I think BlackRock, the reason why BlackRock is number one in terms of ESG scoring at the minute, not only because I think they're the consumer in the ESG world, is that a friend of mine works at BlackRock, and she's in a gay relationship with Julie and Sarah, and Julie works for BlackRock, and they have a coming out day. So it's the first I've ever heard with a financial institution. But you're allowed to come out and say, look, I've been gay for 5 years, or I've been in a relationship, but I really love the support that BlackRock's been giving me. And the performance is unbelievable. They have a big stage, they have lights, they make a big party, but they make it so that the employees feel so important about their own sexuality and their own ability to be able to come out in a workforce and not have any judgment or stigma attached to that. And empowering that staff member, the performance level is amazing, because these people don't want to go home then. They're working from 7 till 7, they're staying up there, they're making it part of their life because they feel welcome. So these kind of sort of soft metrics, these soft touches add up to the bigger argument, and the ability to measure that person's performance on a task by task basis, no matter how minuscule you want to measure it. But again, it's all these things that you can add to the pot, really.
We just got about a few minutes left. Brian, do you want to jump in and have the last word on this, or do you want to?
Doug, I was gonna say, I want to kick it over to you and give you I know it's only a few minutes, but have you seen all of this stuff work with attracting new clients for your business?
Yeah. I mean, you Brian, you said it first. I mean, I popped and heard you. Investors love it. I mean, I think we all love a good feel-good story. And it's just that we know the idea of ESG, and I am an old school romantic. I love the idea that there's a happy ending to this, and I will make sure there is, because that's what I'm about, right? Yeah. But clients, investors, pension funds, insurance groups, they know now that we want good companies, because good companies means they don't want to deal with controversies and scandals and bad behavior, because that turns off not only the retail investor, but also other institutional investors. So we're definitely seeing across the board from the attitudes of some of our bigger clients, who are attracted to the idea of it, because they're seeing the returns. Again, it all ties into the idea that, if we're behaving and we're doing really well, and we've got a conscious attitude to what we're doing with our staff and our environment and our governance, it's going to attract new money. And this new money then, attracts other new money, because they're a good company. The staff are happy where they are. The staff's got a good attitude. On the phone, the customer service is great because they're happy. This then drives the client to want to invest more money because they're getting great service. I mean, Doug, if you've got a choice of 2 wealth managers, and one's a bit of a, he's okay, but he's a bit groggy, but one's really happy and beaming and happy to, over deliver, you're going to see that although you might be getting the same returns, you will want to talk to this guy more because he makes you feel good. Okay.
Yeah, we doubled our AUM since we became a B Corp. So since our B Corp certification, and since our entire firm went to ESG investing, we used to be a mix. We kind of half of our clients were more traditional and half were more in the ESG space. And we basically just made a firm commitment. So this is where our values are. We're going 100% all in. and it's doubled the size of our firm just in a few years. So it's been tremendous, not just from a financial perspective, but also, well, it's been tremendously helpful from a marketing perspective, number one, tremendously helpful from a financial perspective, and also in terms of just an internal satisfaction of getting us excited to get up and go to work every day, and everyone on our team being excited about what we do. We don't, when we're hiring people, it's like, well, do you want to work like you said, Gibran? Do you want to work for somebody who's sort of stodgy and staid and does the same old, or do you want to work with someone who's on the cutting edge of innovation and who's happy and excited to feel like you're doing something good in the world? Like finance can be for many people a little stodgy and boring and dry. And it's like, we're not just here to make money. We're here to actually make sure all of our stakeholders, everyone in our organization, our customers, our employees, our suppliers, that everybody wins across the board. It's just a great way to work.
Yeah, is that there's a definite outcome in ESG. At the end of the day, there's a positive outcome for not only us but the younger generation. There's a good comes out of it. I mean, as you said, Doug, making money, the full stop. Okay, made 8%. Now what? With ESG, it's a continual growth of evolution and being better companies and innovation and so forth. So I think, it's pretty amazing to be part of this ESG family for sure.
Yeah. It's a great community, and it's just great.
Yeah.
I mean, really,
good people.
Yeah. Well, thank you both. Thank you everybody who attended. This has been great.
Thank you very much, guys.
Any last questions or follow up? Anyone in the audience? I know you guys, we've been talking a lot. We've just got a minute or two. Is there any follow up you guys would like us to do for you?
I would just say this was great, and it's like you said, it makes you feel good. Like everyone, we're sort of on the right side of history in a way, and I think there's a little bit of a shift going on that we're seeing happen faster, where there's almost an expectation of this, with companies, and it's very heartening, and I think that their momentum is building for this. Of course, long way to go and all of that, but I don't know. I think that companies are starting to realize that the advantageous expectation that people are having with and seeing the results, that it feels like very good timing from my perspective. And it's heartening to hear that, sometimes you're in a little bit of a bubble and you think that, okay, this seems to be good, everyone's on the same page, but there's not a lot of progress. And when you're seeing a lot of different areas move forward, and just what you talked about with BlackRock, it's really heartening. So I would just sort of give high fives all around.
Yeah.
Good mutual admiration society. This is good.
Yeah,
right.
Fantastic.
Maybe just one question for mine if we still have another minute.
Mm-hmm.
So
go for it.
I think it's, first off, fantastic conversation, really helpful to hear the different perspectives and the excitement and progress that's already been happening. I guess my question is, with so much hype and activity that's been happening, particularly in the last couple of weeks and months, I'm wondering what you think the best sort of allocation of support and needs, like what does the field need most at this point in order to advance, especially as we all think about our respective roles? It's a pretty broad question, but I just think about, like, there's a lot of people that might be rushing to the same sort of things, and I'm wondering what type of for those of us that are thinking about continuing to shape our careers in a way that supports the field.
I'll just say education. I think that's really powerful for all, is just learning more about the ESG space and how it adds to not only the values of what you're doing, but education, just being willing to learn and open more about what it means, really.
And also the big dispelling a lot of myths that are out there. That's part of the education, is dispelling the myth that somehow ESG investing means sacrificing expected returns, and it's just the opposite. That you can get higher expected returns with less risk by investing sustainably. So once people see that, it's a no-brainer. Yeah,
that's what I was just going to say. I think, as we touched on before, like, you have to be doing this in a very prudent and wise way on the investment side, because everyone loves a good story, like I said, till they start losing their money. And this has to be something that we continually, as a group of like-minded individuals, keep pushing that the performance is great, and showing that the performance is great, because this will just be another fad in 5 years if the performance doesn't equal out to be something
very true.
Like, that has to be consistent. And everyone has to keep talking about that it's feel-good story, but there's great performance too.
Yeah.
Awesome. Thanks.
Thank you to everybody.
Yes. We'll see
Cheers,
you
guys.
guys.
Thank you very much.
See you on the other side.
Yeah.
Bye.